Welcome to Season 2 of Time and Materials, a construction-only podcast powered by livecost.com, where we sit down with interesting people doing interesting things in construction. These construction experts kindly give us their time so that you can walk away with the tools to make better day-to-day decisions in your construction career. Okay, so you're very welcome back. Today we're going to drill into the Purchasing Managers Index for construction industry, and that is a report that monitors activity within our sector. The latest report, I don't know what we can say, is probably isn't great, but to dig into that, we're joined by the Director of Head of Research at BNP Paribas, Ireland, John McCartney. John, you're very welcome to the podcast. Thanks very much for giving us your time.
My pleasure, Ciaran.
We like to start this off and try and get an idea of who it is we're speaking to in terms of person, and in this case obviously there's a company behind the report, so I'm sure it's been a busy week for you, John, with a lot of media outlets wanting to know, I suppose, what's going on, and one of the reasons we were keen to get you on as well is to try and dig in and figure out about what's going on. But before you spent your time digging reports out like this latest one, what's your own background? How did you end up where you are today?
Well, I'm an economist by trade, Ciaran, and I specialise in real estate, particularly commercial property. And in the past, I was head of research at Lisney, one of the big traditional commercial brokers in Dublin. And then for 7.5 years, I was director of research at Savills. And since last October, I've been director of research here at BNP Paribas Real Estate Ireland. So that's who I am. In terms of the report, many of your listeners will know the construction PMI as the old Ulster Bank construction PMI, but with Ulster Bank leaving Ireland, BNP Paribas Real Estate Ireland took over the sponsorship of the PMI. So it's a monthly report that comes out on the second working Monday of every month, and it tracks overall construction activity and how that compares with the situation 1 month earlier. So it's a month-on-month measure, and with below the overall index, there are things like new orders and employment and things like that. We can talk about those as you wish. Just to say that for anybody reading the report, the way the index is calculated means that anything over 50 means expansion month on month, and anything under 50 is contraction. So that's it.
Okay. So what we're saying is that we look at these reports, we look at it from a determination point of view of, we're looking at expansion, we're looking at contraction. 50 indicates we're growing, below 50 says we're contracting. This report then give us a reading of 41.8, which is significantly down on June. I think I read in between the lines there that was excluding COVID was the sharpest contraction in 10 years, I think it was. So I suppose let's start with an easy question for you, John. What's going on?
well, you're correct and accurate in everything you say, Ciaran. So I suppose just to set the context for it, if we think back to sort of May 2001, when we sort of pulled our way out of the last real severe lockdown, there had been pretty constant expansion in the construction sector. So we were getting readings of well over 50 all the way from sort of May 2021 up until June 2022. And initially, the expansion was very, very strong. And that, I suppose, reflected a release of pent-up activity, so a lot of sites were obviously shut down by mandate during the COVID crisis. And once works were cleared to resume, then, people worked furiously to try and recoup lost time. And so there was as I say, a very big expansion in the sector during that period. And of course, you were comparing, this is a month-on-month measure. So when you're comparing your early months of activity to the previous months where there was no activity at all, obviously you're going to get very strong growth readings. So anyway, big picture stuff, very, very strong initial expansion through the summer of 2021, began to moderate a little bit towards the end of last year, but still, reasonably solid month-on-month expansion. And through the winter and the early months of this year, but it has been slowing. And then in June, we saw the first absolute pullback in activity month on month. So June was a quieter month than May, but only a little bit quieter. And then in July, we see this quite sharp pullback that you've mentioned. So the index fell from 46.4 in June, which was below the 50 mark, but not a huge amount below, to 41.8, which, as you say, signifies a really quite severe contraction in construction activity. And as you say, the severest for 10 years, if you exclude those COVID periods.
And there was a sharper drop as well. I noticed when I was looking through that the housing figure was actually worse again. I think was 37.9. I took a note off, which looks terrible. Now, a lot of our listener base will be right in that residential space. What's the driving factors there, do you think?
Well, I think the driving factors across the board are really construction costs. We've seen if you look at the CSO data from the wholesale price index, the building and materials cost, I have it written down here somewhere. So materials going up more than 18% year on year, and construction wages rising at about 9% year on year. So input costs are rising very sharply, and we see that in our own sub-index on input costs as well, rising very sharply. Although in saying that, the pace at which those cost increases are running has slowed somewhat. So we're still getting fairly severe input cost inflation, but it has come back quite a bit since it peaked in October last year. So I think that's what's causing it. Your listeners will, on a day-to-day basis, I imagine, be trying to juggle, how do you manage, committing to fixed price contracts in a situation where your input costs are going up so high. And I think at the margin, what that means is that, projects that were only just about viable are the first ones to go by the wayside, and fellas just aren't prepared to take the risk and they don't get done. But I think a critical thing here is to recognize the lags in the system. So what we're talking about here is new starts slowing down, and we actually see that in the official data on commencement notices. If we look at the commencement notice data, they're back about 9% year on year. So there has been a bit of a slowdown there, and that's exactly in line with the narrative that I've just set out there. That at the margin, these projects that were only marginally viable are getting cut. So what we're going to see, I think, for the next 12 to 18 months, maybe a bit longer, is that projects that are already well underway are going to continue to completion. And we're not, I don't think, going to see a massive reduction in the number of housing completions. Not yet. Because what's going to happen is there'll still be activity on those sites where they're already underway and they've made progress and all of that. They'll continue to build out those sites. But I think where we're going to see the slowdown is the number of new starts. I think that's going to slow down. And based on the pipe, sorry, Ciaran, go ahead.
Yeah, I was going to say that there's two views on these critical numbers, isn't there? Like the general public, and I will always be looking at those the number of units completed, and those who are embedded in the industry are looking at what's coming down the pipeline. two bits I wouldn't mind dissecting out of that, John, if you don't mind. You mentioned materials there, 18.5% up year on year. Labour, our wages, we want to call it that, 9% year on year. And you also mentioned something about viability there as well. It was sort of touched on. At what stage, if materials are going up 18.5% year on year, labour 9% year on year, at what point does this become unviable? And the second part to that then as well, like, what can be done, I suppose, against that? Because the demand side of this isn't going away.
Yeah, well, I suppose, look, input costs going up by 18.5% wouldn't necessarily be a problem for viability if prices were going up by 20%, you know.
Yeah.
And so it seems kind of spurious to link the two, but what will tend to happen is if input costs are going up to the point where they choke off activity, it amplifies the scarcity of housing, and that causes people who have the resources, including individuals, but also local authorities and AHBs and anybody else that's procuring available units. You know, the greater the scarcity, the more they have to compete to secure those units and the higher price they pay. And eventually, what that does is it drives price inflation above the rate of input cost inflation and restores viability. But the problem is then that you've got huge affordability issues building up, and that's really a huge issue. So
that was more, that was more. I'm thinking there. My thought pattern along there was like, it feels like we're at a tipping point there with like the affordability point of view. Like, surely, you know, I mean, people surely are at that point where they actually, you know, we are at a point of this is surely we're at maximum. I mean, I've been looking at it. I mean, I'm in a position where I'm at an age where a lot of my friends and stuff are buying, and everybody's in the same sort of boat, saying like it has to be at its peak. We're surely hitting that peak, and I suppose the thinking behind that is, well, if the costs keep going up and we're at the touching point there where people are saying this is getting to my tipping point where it just becomes unaffordable, are we going to, you know, are we just going to reach a point that this is just not viable? I mean, I suppose there is some commentary out there as well, John, that we are reaching, I suppose, a maximum on that rising material cost. What have you seen out there on that?
Yeah, so in terms of input costs, so just to put the numbers on it, you know, as I mentioned last October, the index was running at 90.5, you know, so that's obviously massively above the 50 month-on-month increase. Now, the latest reading we have from July is down to 77.9, so it's still well above 50, so the input costs are still rising, but at a slower rate, and we would hope that some of the factors that have fed into this, including, you know, lockdowns in China and, you know, supply chain issues arising from Brexit and scarcity of shipping and truck drivers and all of those sorts of things, will gradually ease. Because what happened across all sectors immediately after the kind of synchronized reopening of the global economy after a kind of a shutdown everywhere around the world was that all sectors said, okay, we're open for business again, let's get motoring. And they demanded materials and inputs and so forth. And unfortunately, manufacturers and raw material suppliers were not in a position to supply that sudden sharp increase in demand for their products straight away. And it was always going to take time, even if things had run smoothly, and things haven't particularly run smoothly because there have been all sorts of things like, as I say, resurgences of the COVID pandemic in China that resulted in lockdowns, and they do have a sort of a zero tolerance policy of it. And then we get more recent things like the drought, you know, drought conditions which are impacting on shipping in the Rhine, you know what I mean, and things like that. So there's various factors, and of course, this war in the Ukraine that has interrupted the supply of various essential commodities and led to an exacerbation in oil price increases as well, and gas, and that has a direct read on many construction materials, because you need a lot of thermal energy to produce things like cement and steel and so forth. So it's a kind of a perfect storm at the moment, and we would hope that some of those factors would naturally abate. In other words, look, just the passage of time will give manufacturers a chance to catch up on their backlogs, and that should reduce the frenzied competition to secure raw materials and result in prices not going up as fast. And that's what we see now, and hopefully that will continue. But unfortunately, some of the other factors you just don't know, particularly war in the Ukraine. I mean, it's very hard to.
Yeah, we're hopeful. We are hopeful. With this type of stuff, then, John, when we see a sharp decline like we've seen, when would you expect us to see this drop, say, in activity reflected then on, say, new commencement notice numbers?
Yeah, well, as I say, the commencement notices are already down. I have my crib sheet here. Sorry, where do I have it? Sorry, Ciaran, for this. Yeah, but so we had in the first half of this year, we had 14,149 notices issued in respect of housing units, and in the first half of 2021, it was 15,530. So that's a drop of 9% year on year. So we're already beginning to see housing starts pull back a little bit. Now, that won't be, that's still a relatively high number in absolute terms, given, where we've been in the past. So it's not catastrophic yet. And the other thing to say is that there is quite a strong pipeline, and you probably know this better than anyone, Ciaran, I imagine, but there is quite a strong pipeline of residential already underway in Dublin, and those, we think there's about 17,500 units already on site under construction in Dublin alone. Now, I did a bit of number crunching, and it's hard to be absolutely definitive about it, but it looks like about 30% of those have been already underway for more than a year. So given that there's a further, sort of 4 or 5 months remaining in this year, there's a good chance that a lot of that 30%, let's say about 5,000 units, will be completed by the end of this year. So that would mean in Dublin we have about 9,500 or 10,000 housing completions this year, which would be a very strong uplift on any year previously. And critically, that would still leave 12,500 or 13,000 residential units under construction in Dublin to be delivered from 2023 onwards, and the majority of those, you'd imagine, would come through as completions in 23. So I'd be optimistic that that the completions numbers are going to hold up fairly well. And if you sort of apply that to the whole country, Dublin in recent quarters has accounted for about 36% of total completion. So if you sort of apply that across the country, then it would suggest that completions are going to hold up fairly well. The real problem is at the most upstream end of the pipeline, what's going into the pipeline. We already see a bit of a pullback in starts. It's not catastrophic yet, but if the current dynamics that are causing this continue in the way they have been, then I think it will become an issue that will be reflected in a slowdown in completions in 18 months or 2 years.
Okay, so with a sharp decline in what we've seen, especially with those July numbers, in your opinion, not yet time to panic. Would that be right in saying? And then obviously, I suppose, could you summarize then maybe what you think the next 18 months or 2 years look like, John? And I suppose I'm putting a bit of a rub of the magic crystal ball here in front of you now, which is unfair. But I suppose just from what you see in a day to day, and from what you've seen, I suppose, in the data? What do you think the next 18 months or 2 years will look like, in your own opinion?
Yeah, well, I think that we're going to continue to suffer, input cost inflation. I think hopefully that the improvements that we've seen are going to continue, and that the inflation is going to slow, but I think we're going to still see input costs rising. That's going to cause a problem, I think, for developers that are working on marginal schemes. We're already beginning to see in some of the forward-looking elements of the PMI that this is changing people's behavior that are participating in the market. So, for example, the new orders index is down for the last 4 months in a row. Partly reflecting that employment growth in the sector has stalled now. We're doing this interview, is it the 22nd of August or 21st? But the labour force survey statistics for Q2 are not out until the end of the week. But hopefully, if the PMI is doing its job as a leading indicator, it's going to show a slowdown in construction employment. And why is that? Because firms are expecting to be less busy in 12 months' time than they are today. And they're actually telling us this because one of the questions in the PMI is exactly that. Do you expect to be busy or less busy or the same in 12 months' time? And now, for the last couple of months, more firms have been saying they expect to be less busy in a year's time than are saying they expect to be busier. And they're not just saying that. This isn't just posturing. They're acting on it as well, because they're not hiring additional workers in the way that they were, and their order books are not growing in the way that they were. In fact, they're contracting. So my sense of it is that we're going to get a bit of a pullback in activity, and as a result of that, I think it is going to sort of cause a slowdown in overall activity. I think the balance of activity will shift from early stage construction activities like site enabling work, site clearance, site establishment, all of that sort of stuff. I think on balance, we're going to have less of that going forward. We're going to have more of the balance of activity that is happening will be in late stage construction, finishing out schemes. But there is still time, hopefully, for conditions to change to improve the conditions for viability as we move through. But unfortunately, that might look like continued high house price inflation, and that's not really what we want to be drawing out construction. You know what I mean? We would like to see more construction activity at moderate rates of house price inflation, but I don't think that's necessarily the way it's going to pan out.
No, hopefully not. Hopefully we can see a balance, but yeah, I'd probably be in your camp. As looks like all the signs point towards we're definitely going to see some decrease in activity. There's no question there. John, you've been very kind with your time. If people wanted to reach out and learn more about you, the company, or even the report, where could they find that?
Yeah, so if they go onto the BNP Paribas Real Estate Ireland website, the report will be on that, or they can sign up to subscribe to the report as well. We'd be happy to add them to the circulation list,
Brilliant stuff. John, I appreciate your time. Thanks for coming on.
My pleasure. Thanks for inviting me.
Time and Materials is brought to you by LiveCost, the construction software fully designed to manage your construction financial forecasts. Visit livecost.com to take a product tour, or reach out to our team of construction cost experts to transform your project profits. Any links mentioned during this episode, including speaker profiles or any other resources, are available on the podcast show notes. Your feedback is also welcome. We would really appreciate if you could take a moment to leave us a review or email your comments, guest suggestions to hello@timeandmaterials.com. Finally, if you haven't done so already, please don't forget to subscribe. Thank you for listening. Until next time, I'm your host, Ciaran Brennan.